Sharon Ambus. I'm going to start there in about 2 minutes. Thank you for coming on this webinar this afternoon. This is the last of a series of 3 that we've done over the last 3 weeks. There will be one final one next Wednesday, but that's going to be very specific in respect of one of the areas that we're covering, which I'll be covering off today, which is going to talk about tax and tax saving opportunities. But I'll go into that a little bit later on in the webinar. I'm going to spend about 20 or so minutes just running through a few areas of financial planning. I'm available afterwards for kind of any queries, but I'll be doing it offline if that's okay. We just found that it probably works better just to maybe deal on a kind of a one-to-one with people in terms of any of the specifics. And we are recording this webinar, so we will have it available for anyone who wants to see this, or indeed the slides afterwards. So what I'm going to do is I'm going to get started. As I said, thank you very much for those of you that are attending. My name again is Nick Ambus, and I'm the Managing Director of Alpha Wealth. So just to kick off, we are a financial services company. We have offices in Little Island in Cork, and we have a small presence in Dublin. We have 6 advisors who are all QFA qualified, and we provide independent financial advice to individuals like yourselves. The mainstay of what we provide really is in terms of helping people save money, plan for their future, and maximizing really their financial objectives. And this could be in many different areas, whether it's to have a house of their dreams, to retire early, or whatever path that they want to follow. So I'm going to, as I say, go through a few areas with you today. It's going to be broken up typically into 5. And as I said, some of these will relate directly to yourself, and I'm going to try and make it as meaningful as I can. So just to start off, the first thing is that we don't charge for the advice that we give individuals. Many financial advisory firms do. I was listening to a webinar there earlier from a financial advisor who's charging 1,500 euros plus VAT for a financial review, which I think is outrageous. But basically, the way that we're remunerated is through the insurance companies that we place business with. And the way I'd position that with you is to say that we act as a broker. We provide advice to individuals, and we provide product solutions. And there's no obligation for people to take our advice. It's very transparent. We're regulated by the central bank from a regulatory perspective, but it's about giving people independent, sound advice in whatever walk or area that they have interest in. So the 5 areas I'm going to cover off on are mortgage advice, retirement planning, tax savings, savings and investments, and insurances. And I feel that these are relevant to most of us. Certainly, I talk about myself as an individual. I'm 46 years of age. I am a business owner. I used to be PAYE, and I feel like I've been through a lot of the scenarios and going through a lot of the scenarios, and whichever cycle in the financial, I suppose, period that we're in, all of which I think are relevant to us. The last thing I want to say on this is that we are a low-cost broker. I've seen many insurance companies and many insurance providers and brokers completely overcharge clients. And when I set up Alpha Wealth 6 years ago, I set up an objective of saying that we would never overcharge a client, and I always stick to that mantle. So the first thing to say to all of you is that I always recommend to clients that they do a financial plan once a year. And it starts with a budget. So if we look at ourselves as a balance sheet, and on the left-hand side, you just put your income, net, and that of your partners, if it's relevant. And on the right-hand side, you list where you spend your money. And these include things, obviously, that we're forced to pay for, such as rent, mortgage, car insurance, and so on. But there's many of those that we choose to pay. Now, we've been through a very unusual period over the last 3 or 4 months. And many of us have had to work from home, which in some respects has enabled us to actually save. We've not been able to spend, obviously, as much going out and so on. We've not had to travel to work. And it's about trying to keep in good habits, but also reviewing what it is that we're actually spending our money on, and what we're doing with it, and how we can better utilize that. So there are many things that we, as I say, do spend our money on, whether it be mobile phone insurance to life insurance or illness cover, paying bank fees, which we try to mitigate or indeed avoid. But some maybe less obvious ones, such as pension fees and costs that are maybe not explicit in many of the things that we buy, including insurances, and whether or not it's worthwhile paying for things additionally. I spoke to a client yesterday who was paying approximately about 130 euros a month for mortgage protection insurance, which I think is excessive for any client. And we discussed the nuances of why that was the case. And it wasn't so far that it was the amount of cover that they had. Firstly, it wasn't particularly competitive, but outside of that, there was just more tax efficient and more cost effective ways of them achieving the same cover with a lower cost. And that's why it's important for people to get an independent review. So just to move on to the first area, which is mortgage advice. For those of you that have a property already, which would include myself, I've suggested them all that they would look at what they are paying for the bank for the use of this money. Mortgage rates have become more competitive over the last 12 months. We are seeing some pressure from Europe, and many of my clients tend to have a good view as to how much they owe the bank and for how long, but not a massive amount of them would have a good mind as to what rate of interest they're paying. And for me, that's the key indicator. It is very important for people to understand what is their rate of interest. Now, there's a few of us that are lucky enough to still have a tracker mortgage, and we hold on to them with both hands. But for many of us that have a variable or a fixed rate, then this is where we look at the rate that we're paying. The general ballpark at the moment that I say to clients in relation to their own private homes is that they should be looking to get a rate of around 2.5% per annum. And that's the kind of the ready reckoner. Now, it varies in some instances, but as I say, it's definitely worthwhile people position themselves. And it's not to go through hassle or rigmarole around trying to, get a rate reduced from, say, 3% or 2.8%. In many instances, this can be done very easily, even with our own banks. It just takes a little bit of, I suppose, forward thinking and just a little bit of proactivity. And then we can assist you with this. We are not mortgage brokers. We have a mortgage license, but we prefer to remain independent and assist our clients in getting the best result for themselves without being tied to any particular institution or having any bias in this. For those of you that may be looking to get onto the property ladder, or maybe looking to upgrade or to downgrade even, we help people in getting mortgage ready, whether that's building up savings, getting into good savings habits, or looking for the best bank that would suit them. We are seeing banks are looking to borrow money again, but they are also looking for excuses not to lend money. And it's about making sure that you're in the best position possible. So just on the area of retirement planning, and many of you may have a company pension plan in place. Very few of us now have the old form of pension known as defined benefit, which was a kind of a fixed pension for those of you that were lucky enough to obtain them. The more common type now, which is called defined contribution, or for anyone who's paying into additional contributions, that creates investment decisions that people must take, whether they're conscious of it or maybe unconscious of that. And we assist them independently in making sure that they make the right choices for them. Again, during this period of COVID, there's been a lot of movement. We had a massive pullback in late February, as I'm sure many of you are aware. And we also had a big recovery. And it's about helping people navigate their scenario. And it varies for different individuals. There's not a one-fits-all solution to this. And it's nice to just get some independent advice. We're not looking to sell company pensions. We cannot do so for those of you that have pension schemes with your employers. But it's about just giving a value add. without any drama, and it makes the process very simple and transparent. And it's putting things in layman's language that people can fully understand. So whether it's a sense of whether you're in a default fund or whether you should be in a fund that's more suited to yourselves, and indeed what type of contributions you should be looking to make to achieve a reasonable lifestyle in retirement. A lot of our clients look to try and see, can they look at the option of retiring early, and we assist them with that. And the key thing that we provide all clients is a projection based on the pension fund that they have and what is suitable for them. Many of us have pension schemes from previous employers, and this is where we can assist clients in checking what they have with a previous company and whether it's still fit for purpose. Should they look to move it into their new employer? Should they look to move it into an alternative scheme that may save them money or that may give them a better return than what they're currently getting? Pensions are still very tax efficient. I will talk about this in a second on the next slide, but the key thing to remember for pension schemes is that if you are a high rate taxpayer, i.e. if your earnings are over 37,000 a year or more, typically for every euro that you earn above that, you're suffering tax at roughly 50%. And paying into a pension scheme gives you 40% immediate relief, which is very attractive. And the key thing is that the contributions grow tax-free. Many clients have asked me of late about investing in stocks and shares. And I say to them, well, you can do that, but you can also do that through a pension scheme. So you can get the best of both worlds. You can get the tax relief, but you can also get the advantage of investing, you know, whether it be in large tech companies or whether it be in a more diversified, steady fund. And this is where we again advise our clients and help them in this cycle of, you know, long term. The key thing for those of you that may not have a pension scheme is to start. It's never too late to start. And we help people in giving them a sense of what kind of contributions they should be looking to make into a scheme. The rough rule of thumb is typically somewhere between 5 and 10% of your salary would be a reasonable amount to go into a pension scheme. If that is assisted by your employer, all well and good. So to get to the nub of what I wanted to speak about today, and it's really about trying to reduce the tax that people suffer. It's very hard to avoid the tax man, but there are some ways in which we can do so. I've spoken there about pension schemes, and they are still a very attractive mechanism for people, and it's something that's sometimes forgotten. You know, we talk about pensions, most of us know it's a good idea, but maybe forget the reasons why, you know, it makes sense for us to do so. So somebody who's earning, say, 50,000 a year, they will inevitably be suffering some tax at the higher rate. They can get some of that tax back by putting money towards a pension scheme, whether it's an independent scheme or whether it's an employer plan for a company they work with. You know, it makes sense. And again, it's worthwhile knowing where the money is being invested and what fees people are paying. The other area is that, again, it came more prevalent during COVID. Employers can avail of a €3.20 relief per day for their employees. And it's something that you should check with your employer whether that is something that's being made available to you. And this is referred to as a stay-at-home relief. Now, if your employer is not providing you with that, and it's not an obligation on their part, you can claim for 10% of the bills that you've suffered while working through home. And many of you may continue to do so. So it is something that you should look to avail of. Now, I'm often asked whether, you know, it's something that you have to keep receipts for, and it's not. Although I do say to people, you should do so just in the event of the audit. But revenue have typically allowed individuals to claim up to 10% of their bills that was relate to things like electricity, heating, and phone. It's done through the RS system, or the ROS system, more commonly known, and I can assist you with this. Again, if you want to refer back to me after the webinar, I can send you on very simple details of how to go about claiming this relief. The third area that can help you in reducing tax is a scheme which is a government-sponsored scheme called the Employment Investment Incentive Scheme. Now, as I mentioned at the start of this webinar, there is a session next Wednesday at 1 o'clock. It's the last of the sessions before the summer break, that we're going to do specifically around this, and it would be well worthwhile for anyone who just wants to even educate themselves on this type of relief as to the benefits of it to them. And it really relates to anyone that is paying tax at the top rate. So again, typically for anyone who's earning over 37,000 euros a year or more, I would suggest strongly that they would at least be aware of what this scheme does, because this scheme is available to individuals every year. So whether you look at doing it this year or next year, or indeed in 4 or 5 years' time, it's worthwhile knowing that this is available. Now, typically the way it works is that if you're in a position where you have some savings or are able to get some savings together of a minimum of 5,000 euros in the calendar year of question, so obviously between now and the 31st of December for 2020, and I'm going to use an example of, say, 10,000 euros, and you invest in this government-sponsored tax-backed scheme called the EAAS scheme, you will avail from getting 40% of that contribution back next year. So of the 10,000, 4,000 euros will be given back to you from the government in the form of a tax rebate or relief. Therefore, your net investment of 6,000 carries over, and the term of the investment is 4 years. So at the end of the 4 years, you would expect to get back your 10,000 euros and a return from a company that you place this money with, typically in the order of about 20%. So the net effect of this is that you have invested 6,000 euros and you have looked to receive back 12,000. It's a double your money return. Now, people often ask me, well, Nick, is this tax, free? Is it guaranteed? Now, the return is pretty much tax-free, and certainly the 4,000 euros rebate per 10,000 is a rebate of tax. In terms of the guarantee, that's dependent on the company that you place the money with. Now, the webinar next week, we have whittled down the companies in this area to 3 that we would strongly recommend. And again, we act as independent advisors to have vetted all of the companies in this space. We would know the company owners. We find it very, I suppose, important that we would have a sense of who these companies are, what area they're in. And they're quite diversified. For those of you that can join the webinar, or if not, we can talk to you on a one-to-one basis. These companies vary from an IT company to a whiskey company to a company that provides a dairy bar in the health food space. Really good companies with really well-run businesses with good business owners. And you'll get a sense of that next week, because I've asked them all to come along and give a 5-minute spiel on each of their companies. And the returns to the individual, as I said, can outweigh the 20% that's typically offered through this. So just to move on to the area of savings, it's important for all of us to save, whether it's for our kids' education, whether it's for a house, whether it's for a rainy day. It's really relevant, especially in this environment where interest rates are at nil. For those people that have monies in the post office or the banks, I say to them that as safe as the money is, unfortunately, there is no return, and it's unlikely there's going to be for the foreseeable future. So it's really important that we get our money working for us, particularly in terms of saving regularly. If you're putting money away every month, in my view, it makes no sense really just to put it into a place where you're going to get nothing back. So there are some very good options out there through some of the insurance companies that we would recommend to individuals. And the key thing, and some of you may already have these, is to check what fees you're paying, because some of them can be extremely expensive. I used to work in the banks. I was with AIB for 8 years, and we used to provide these schemes at horrendous rates. And unfortunately, people weren't really familiar with the fact that they could shop around. We were tied agents of Arc Life, so we never really provided any alternatives. As an independent company, we are vehement about ensuring that we provide best advice with the cheapest products available to our clients, which are the best of their type. For those of you that may have some monies sitting in the banks and may have availability to invest monies, again, there are a plethora of options available to individuals. It's really important to make sure that you get appropriate advice for what's suitable for you. Many brokers will happily take money off clients maybe not always with their clients' best interests. We feel very strongly that we would always endeavour to make sure that clients are given a variety of options and explain and make them understand the benefits to them and the amount of access and availability that they would have with these, and ensure that they're risk appropriate for what they want. We've seen this massive, I suppose, recovery of stock markets since the pullback 4 months ago, and it's really important that people get advice. There are some very good opportunities out there. Again, we're very au fait in helping our clients with this, but I would say to everyone just to tread carefully, and it's important maybe just to check in and see where you are and get advice. By the way, there is no obligation to take the advice that we give individuals. We're not looking to try and sell everything to everybody. The key message that we're trying to give our clients is that we want to ensure that they get appropriate advice and that they are comfortable where they are. We're looking at a long-term relationship with our clients, and we provide annual reviews and updates to them, as well as online access to their holdings if they require. It's just providing this transparency in a working relationship. So finally, I just want to talk about the area of protection insurance. It's not the most interesting topic to finish on, but no less important. There are many things that we spend our money on in terms of insurances, whether it be our house insurance, our mortgage protection insurance, which is mandatory when we buy our properties, to things like car insurance, travel insurance, and so on. And we provide an independent review of insurances that clients have. We have a really good team that do all the heavy lifting. The only requirement we have from someone is just to sign an authorization, which doesn't cost anything or do anything to the policy, but it lets us have a look and see on the plans that they may have. And we report back to them in a spreadsheet, showing them what cover they have, what it does for them, what it costs. And it also gives them a comparison, an alternative on a like-for-like basis. We've come across so many people that have purchased insurances where they wouldn't necessarily be fully in tune with what they actually bought. And sometimes these direct debits continue, maybe unbeknownst to them, where we go in and say to them, well, look, this is what you have. Is it still fit for purpose? Is there something better you can do with that money? Would it be more appropriate for you to do something different? Has your situation changed? Should you maybe allocate some of that towards savings for your kids or towards your retirement planning? And it's all about making sure that you have the appropriate portfolio built up. We talk about the morbid areas of life assurance and illness cover. These are products that we do provide, and again, at the lowest cost possible, dealing with all of the insurance companies out there. And it is important, I suppose, given the scenario we've just seen over the last few months, to just check in and see what we actually have and maybe just get an idea of what is appropriate for us. But it's really important to achieve it in the most tax efficient and cost efficient manner, which we'll endeavour to do. Now, as I said, I wanted to keep these at a relatively kind of short level. There is some more information that we can provide individuals by way of email or indeed on a one-to-one basis. We have a really good team in Alpha Wealth. We have 4 advisors, myself, David, Rebecca and Tracy, and we provide the same level of advice, maybe slightly differently, just depending on our own little nuances. But it's advice that we give from the heart, and it's really important at this stage, especially for those of us that want to try and get into good habits, particularly post-COVID, ensure that we're not doing anything that's incorrect. Or it might be a case of just tweaking what we have, or just checking in that we're on the right path. I think it's really important, as I say, especially from an independent advisory firm. And for those of you that have a financial advisor, we're not looking to step on people's toes. It may be no harm even just to get a second opinion and check back with them and say, well, listen, we've got some advice elsewhere. What do you think? You know, I say this to people, we're not trying to be all things to all people. As I say, the next session we're going to do next Wednesday, and some of you have already registered for that. But those of you that haven't, please feel free to email me. We'll be keeping it to strictly 30 minutes, but it will be specifically teasing out the tax-back scheme that I referred to earlier, which I think is it's a game changer for many of us. Pascal Donahue in the budget last year breathed life into the scheme. And it really is important that, in my view, as much as we understand the benefits of having a pension, that people would be familiar with the benefits of having the ability to actually do something like this. And whether or not you're in a position financially to be able to invest the minimum, which is €5,000 this year, the key thing is about saying, well, maybe I can work towards doing this next year or the year after by putting some money away every month and building up this amount that I require. And that's where a little bit of financial planning comes into play. I'll just remind you that, as I said, there is no obligation to take our advice. It doesn't cost anything. And we are very keen to try and engage with individuals, hence why we've run these seminars. And it's about really making sure that, you know, people are being given appropriate advice. So lastly, I'd like to thank you for your time. As I say, whether it's dealing with David, Tracy, Rebecca, or myself, please feel free to touch base with us. As I say, the video will be available after this, and indeed the presentation slides. And if anyone wants any area, even if it's in just one area that I've covered off today, please feel free to touch base with us. I'd like to thank you again, and I hope you enjoy the rest of the afternoon. Thank you.
Thank you.